Financial reporting. Chapter 1 to 14 we have covered so far. So let's move forward a new chapter, chapter 15. In this chapter, there are two accounting standards, one IAS37 and other is IAS10. So let's discuss what is IAS37. IAS37 is about provision, contingent liability, and contingent asset. Provision. We need to account for in the financial statement. And there is accounting entry of provision, debit, expense, credit, provision liability. There is no accounting entry of contingent liability and contingent asset. They need to be disclosed only. There shouldn't be any account balance in financial statement with the name contingent liability, contingent asset. Their disclosure is required in the financial statement. While provision, we need to account for how expense as well as liability. What is provision? If any event meeting three conditions of provision, there should be provision. What are the three conditions of provision? Present, legal, or constructive obligation from past events. Present, legal, or constructive obligation from past event. Probability of future economic outflow. Amounts can be measured reliably. Measured are estimated reliably. If any of the event meeting these three conditions, there should be provision. If any of these conditions is not fulfilled, there shouldn't be provision. In all these three conditions should be fulfilled. Suppose in the past, company have dismissed his employee. Now employee have sued against the company for unfair dismissal. And he has a sue for damages of $100,000. And due to dismissal, I got sick. I got heart attack. I was hospitalized. I bear a huge expense of the hospital because my dismissal was unfair. Even I remained unemployed for last 4 months. I spend my all expenses from my pocket. So as my dismissal was unfair, so company need to pay me these damages. What is this? Present legal obligation. Mean through law true case because law protect the employees. Employment law protect the employees against unfair dismissal. If there is court case in court and the court have summoned the company, you need to come and provide information regarding this matter. So there is a legal obligation. From past event mean company did something in the past, mean they dismiss the employees. If there is probability of future economic outflow, economic mean in money terms, outflow mean payment. If there is probability mean there are chances company need to pay the amount. And probability mean chances are greater than 50%. Chances are greater than 50%, there is probability. And amounts can be measured reliably mean how much money company need to pay. That is claim 100,000. So in that case, company need to create a provision. Expense debit, provision credit. If any of the condition is not fulfilled, like there are chances below 50%, mean there is no probability. That is called possibility. If chances are less than 50%, so that is called possibility. In that case, there shouldn't be provision. If all these three conditions fulfilled, company need to create a. Who will ensure whether probability, whether possibility? Any legal experts, lawyers? They will provide information whether there is probability or possibility. Is it fine? In the past, company did some environmental pollution. They disposed of their dangerous chemical not according to law. Any legal body have sent a fine letter to the company. Company is defending the case in the court. So if any legal body have put in the fine, that is present legal obligation from past event. If there is a probability that company need to pay the fine, what is the amount of the fine that is also written on the fine letter? So in that case, there should be. If the amount is not known, if there was no law, or there is no probability, there shouldn't be forbid. In all these three conditions should be fulfilled. Can you understand this? What is meant by constructive? We haven't discussed yet. If there is no probability but possibility, mean less than 50% chances company need to pay the amount. In that case, we need to disclose contingent liability. If there is no probability but possibility, mean less than 50% chances, in that case, we need to provide a disclosure of contingent liability in notes to the accounts. Is that fine? What is constructive obligation? Legal mean according to law that is imposed on the company. Constructive mean company has himself created the obligation. Company has himself created the obligation. In case of suppose company is providing a warranty against its product. If company is providing warranty, there are chances company need to pay the warranty claim. Because customer will claim the warranty. And according to prudence concept, always anticipate future losses. future expenses. If you are aware of it, record them immediately. Revenue should be recorded when they are earned, but future losses, expenses should be recorded immediately. So this means there will be future warranty claim expense. This is obligation, but not legal. This is what constructive mean company have constructed by itself. If they have advertised or if they have signed a card, warranty card with the customer, so there is a probability of future outflow. How much amount? How much amount? That you can make best estimate based on the past year warranty claim results. Or you can make a guess, or you can consult any of the specialist. So that can be calculated. Obviously, that will not be exact. That will be estimated. So company need to create a provision. Because this is constructive obligation, not legal, constructive obligation. Company created by himself. Can you understand this? When provision should be recorded? So chances more than 50%. Probability less than 50%. Possible. Probability is also called likely to happen. While possibility, unlikely or less likely. Unlikely or less likely. If there are chances above 95%, that is called certain. If there are chances greater than 50%, but less than 95%, that will be called probability. If there are chances less than 50%, but greater than 5%, in between 5 to 50%, that is called possible. But if there are chances less than 5%, less than, not greater than, less is L shape. That is called remote. Certain, more than 95% chances. Probability, above 50, but less than 90. Possibility, below 50, but more than 5. Remote, less than 5%. In case of outflow, in probability provision, in case of possibility, contingent liability that we have discussed so far. But if there are chances more than 95%, in that case, you need to record a liability. If there are chances less than 5%, take it off. Can you understand this? If there is chance of a future economic inflow, company have signed a contract with any other company. Mean A company signed a contract with B company and B company breached the contract. A company have a sue B company for damages. Mean A can receive damages. Is there inflow or outflow? Inflow. That is inflow. If chances are more than 95%, you can receive amount from B company. You need to record this as asset. Receivable. If chances above 50%, you need to record probability contingent asset, not record. You need to disclose contingent asset in notes of the accounts. If chances are below 50%, if chances are below 5%, mean contingent liability in case of possibility of outflow, while contingent asset in case of probability of inflow. Can you understand this? These are what? Chances. Shall we move forward? Okay. IAS 37. Provision, contingent liability, contingent asset. Illustration 1. A retail store has a policy of refunding purchases by dissatisfied customer. It will make refund in like warranty. Even though it is under no legal obligation to do so, I mean, there is no law. They are constructing by themselves. Its policy of making refund is generally known. Everybody knows about it. It's not secret. Should a provision be made at the year end? Yes, because there is constructive obligation, and if you are, everybody knows there will be refund. About what amount? You can estimate from your past results. Previous year, how many refund you made? At least with that amount, you need to create a proof. Mean a reliable estimate can be made. Mean if a figure is not known, whether that can be estimated. If even it cannot be estimated, then there shouldn't be provision. Illustration 2. An entity sell goods with a warranty covering customers for the cost of repairs of any defects that are discovered within the first 2 months after purchase. Mean providing warranty for 2 months. Past experience suggests that 88% of goods sold will have no defect. Mean they don't come again for warranty claim. 7% will have minor defect warranty claim. 5% will have a major defects warranty claim. If minor defects were detected in all products sold, the cost of repair would be 24,000. This is an estimate. I mean, whatever is our total sale, the minor defect warranty will be 24,000. If major defects were detected in all products sold, the cost would be 200,000. What is the amount of clean? 5% of that and 7% of that. This is the provision you need to create. Simple. Textual understanding 3. An entity has to rectify a serious fault in an item of plant that it has constructed for a customer. The individual most likely outcome is that the repair will succeed at the first attempt at a cost of 400,000. Most likely. But there is a chance that a further attempt will be necessary, increasing the total cost of 500,000. What amount provision should be recognized according to most likely mean 400,000. This is because the best estimate of the liability is its most likely outcome, not the worst case scenario. Probability above 50%, virtually certain, greater than 95% probability, greater than 50%, possibility less than 50%, remote less than 5% in case of outflow, in case of inflow. What's the accounting entry of provision expense debit provision credit? In case of increase provision expense debit provision credit. In case of decrease, that is very rare. Reverse the entry provision debit expense credit. Warranty provision guarantee. Business do not provide guarantee on its product. They provide warranty. Guarantee is provided against any other person. One person is going to take a loan from the bank. Bank asked, please provide us guarantee of any other company. If you have provided guarantee against loan of any other, your subsidiary, your friend, any other person, and if there is a probability he will not pay back the money, you need to create provision in your books because you have provided the guarantee against it. Guarantee is not against product. Against product, what business provide? Warranty. Guarantee is provided against any other entity, any other person. So in some instances, particularly in groups, mean subsidiary is going to take a loan and parent company providing guarantee. One entity will make a guarantee on behalf of another to pay off a loan, etc. if the other entity is unable to do so. A provision should be made for this guarantee if it is probable that the payment will have to be made. Not that person, you. So it may otherwise require disclosure as a contingent liability. If chances are less than 50%, you need to pay. This means if you have provided guarantee, at least you need to provide a disclosure of contingent liability. Because there could be different circumstances. If that company is facing serious cash flow issues, then there is a probability you need to make the payment. In that case, you need to create provision. If their business situation is normal, who took the loan, this means chances are less than 50% you need to make the payment, they will make the payment. In that case, contingent liability disclosure. What is onerous contract? We have discussed onerous contract in IFRS 15, construction contract, loss-making contract. If you are aware your contract is going to become loss-making, you need to create provision for the extra cost. Provision for the extra cost. Sometimes company need to create environmental provision as well. Like you are going to install a machinery somewhere for business operation. And you are going to install machinery for 5 years. And after 5 years, you need to repair the environment in that area where you perform your business operation through machinery. Like you have to clean the land over there, might be you have to plant some trees over there. So if you have decided this, in fact, you have advertised this, I will do this. This means this will be your future expense. So you need to create provision for this. This is called environmental provision. Not somebody imposed penalty on you for environmental damage. Obviously, that will be provision. But if you are going to start business operation on some area, and during that business operation tenure, you will affect the environment a little bit. So at the end, you decided, I will clear the environment. I will bear some environmental cost. So if you have decided this, you need to create provision for that environmental repairing amount cost. How? By using the discounted at present value method. See this example. Test your understanding one. Discuss whether a provision for the cost of cleaning the site should be made and prepare extract of the financial statement. Whether provision is required or not, if required, with what amount, and you need to prepare financial statement extracts, P&L, balance sheet, any figures you need to calculate. Rousley is a company that carries out many different activities. It is proud of its reputation as a caring organization and has adopted various ethical policies towards its employees and the wider community in which it operates. In company claim, we are very caring. We behave ethically. We consider best for all. As part of its annual financial statements, the company publishes detail of its environmental policies, which include setting performance target for activities such as recycling, controlling emission of noxious substances, and limiting use of non-renewable resources. Meaning its annual reports, company claim this, we consider these things, and these are our environmental responsibilities that we do perform. Mean they are publishing this. This means if you are publishing this, there is constructive obligation. You need to do this. And to do this, you need to bear some cost, obviously. For that, you need to create a provision. The company has an overseas operation that is involved in mining precious metals. Obviously, to mine metals, you need to install some machinery. And the machinery used in mining, after completing the operation, they will not be for further use. Only some parts you can draw from that area. You cannot say, okay, I will move this machinery to somewhere else and use that again. No. The activities cause significant damage to the environment, including deforestation, cutting trees. The company incurred capital cost of 100 million in respect of the mine, and it is expected that the mine will be abandoned in 8 years' time. Meaning you will perform your business operation for 8 years. And the machinery cost, fixed asset cost, you have where 100 million. That you need to capitalize, record as asset, need to depreciate as well. For how many years? 8 years. The mine is situated in a country where there is no environmental legislation, though there is no legal obligation. Obligation companies to rectify environmental damage, and it is very unlikely that any such legislation will be enacted within the next 8 years. I mean, there will be no laws. As you are publishing in your annual reports, so you have constructed obligation from yourself. So it has been estimated that the cost of cleaning the site and replanting the trees will be 25 million if the replanting were successful at the first attempt. But it will probably be necessary to make a further attempt, which will increase the cost of further by 5 million. I mean, probably amount will be 30 million. The company's cost of capital is 10%. Whether company need to create a provision? Yes. For this 30 million. And this is environmental cost along with your assets. So you need to discount it using present value method. So how you will record this? For 100 million, you will record debit asset, credit cash. But for this 30 million, you need to record using present value method. But you will record the accounting entry debit asset, not expense. So this expense is not now, that will be after 8 years. So this is relating to this asset. So we'll debit asset and credit provision. By how much amount? 30 million multiplied by 1 divided by 1.10 raised to power 8. How much? 13.99. 13 point? 14. So with 14 million, you need to record this amount. Now the asset will be 114. Now your asset amount will be 114. You will depreciate 114. Mean at year end, you will record depreciation, debit, depreciation expense. Is how much? And credit accumulated depreciation. With how much? 114 multiplied by, divided by 8 years. 14 point. Every year. You need to record the interest every year as well on this 14 million. That is this according to this 10%. You need to record the interest as well. So the entry for provision was expense to provision. Why are we taking asset? Can't we say environmental expense to provision? But this is relating to the asset because that asset will create environmental damage. So, but like if without asset, then expense. If it's relating to any asset, you will attach with the asset. So we at year end, we need to record debit, finance cost, credit, finance cost mean interest payable. How much? 10% of 14 million. How much? 1.4 million. What are the extract of financial statements? In statement of profit and loss, you will record what? Depreciation expense of how much? 14.25 million and finance cost of what? 1.4 million. In statement of financial position under non-current assets, you will record asset mean machine with what? 114 million. 114 million. Under non-current liabilities, you will record provision of what? 14 million plus current year interest, that is 1.4 million, 15.4. That will be added to this every year. And this premium will be increasing every year. At the end, 8-year life, it will become 30 million. And in current liabilities, we will record finance cost payable, because if we're gonna pay after year end, that is 1.4 million. These are the financial statement extract. If there is any environmental obligation relating to any of the asset, so we need to create provision with discounted at present value method. It should be added to the asset cost, should be capitalized to the asset cost. So that's only for. So through this, we will be charging depreciation every year. We'll be charging finance cost. What is the restructuring? Major changes in the business. If business going to stop some of its main operations, are going to change some of its main operations, that is called reorganization, restructuring. We are going to change structure of the organization. You are going to close some of your business branches, that is called restructuring. You are going to change some of your business operations, that is called restructuring. Obviously, if you are performing this big change in the business, ultimately you have to bear some of the expenditure. So that will be called restructuring provision. That will be called restructuring provision. So a restructuring is a program that is planned and controlled by management and materially changes either the scope of business undertaken by the entity, major changes, the manner in which the business is conducted. Before you were producing petrol cars, but now you have decided to stop production of petrol cars, only electric car will be produced. That is restructuring. Major changes in the business. So a provision may only be made if a detailed, formal and approved plan exists. The plan has been announced to those affected. The provision should include direct expenditure arising from the restructuring. Exclude cost associated with ongoing activities, with your existing business operation cost, that will not be included in provision. Relating to new business activities, changes in the business, that for that expenditure you need to create a provision. Illustration 4. On 14th of June 20x5, a decision was made by the board of an entity to close down our division. On 14th of June. The decision was not communicated at the time of any of those affected, and no other steps were taken to implement the decision by the end of 30th June 20x5. The division was closed in September 20x5. Should a provision be made at 30th June? Oh, if there is no announcement, you haven't informed anybody, so there is no constructive obligation. No provision should be. If you announced, if you inform the staff, inform the public, we are going to do this. This means now it is imposed on you, you have to do this. For that, you need to create a plan. Section 5, a common example of contingencies arises in connection with legal action if A sues B because it believes that it has incurred losses as a result of B faulty products. And there was a contract between A and B. B provided faulty products to A, or B breached the contract. So A will receive money, B will pay money. Then B may be liable for damages. Whether or not the damages will actually be paid depends upon the outcome of the case. So if there are more than 50% chances, B will create provision, but if there are less than 50% chances, he will disclose contingent liability. But if there are more than 50% chances, A will receive money, A will disclose contingent asset. I mean, through this example, they have just explained what is contingent asset, what is contingent liability. And accounting, they need to be disclosed. There is no accounting entry for contingent asset, contingent liability. During the year to 31st March 20X9, a customer commenced a legal proceeding against our company, claiming that one of the food product that it manufactures had caused several members of his family to become seriously ill. The company's lawyer have advised that this action will probably not succeed. What does that mean? No payment. No payment we need to make. Customer is idiot. He suffered his stomach due to some other things. Might be they are drinking bad water. They are drinking water from the null. That is coming through recycling process. So should the company disclose in its financial statement? No, ignore. Why you are looking at me like this? What do you want? You want to go home? Okay, go. This small standard we'll discuss in next class tomorrow. We'll discuss some questions relating to this chapter and we'll move forward. Is this the same thing as in audit? Yeah, same thing in audit, same thing in financial accounting paper as well. There could be some bit difficult question like the first question we covered regarding environmental provision. That is not in audit, that is not in financial accounting. This. Yeah, almost same. Almost same examples. See you tomorrow.
Okay, sir. Good night.